I know that you think that market concentration and the gains therein is actually a positive storyline from a macro standpoint, and that to me is a bit contrarian of a statement. Where do you see the silver lining in this concentration? We were just talking about, the role NVIDIA plays.
Well, I think Mike actually summed it up really nicely at the beginning of this segment, or just before I came on, sort of saying there really is no right answer. I think taking the other side of concentration is an interesting way to go. I'm happy to do that, and I think there is a story that says concentration isn't really that bad. We want innovation. We want productivity gains. We want entrepreneurial behavior to guide the technological advances that really drive growth over the long run, whether it's innovations in the 1800s in the railways or motorized vehicles or the cotton gin or any great invention that came along. They are displacing, they are creatively destructive, and you want winners, you want big winners. The idea that every stock in the S&P 500 would be up exactly 12% today sounds completely silly to me. That's how we would describe a good market, is everybody's equal in their gains and nobody loses. Sounds awfully socialist to me, and I kind of go for the more capitalist outcome of we want big winners, we want things to change, we want things to grow. There should be losers. Not every company gets a participation trophy.
Yeah, and sometimes, as you know, David, those losers eventually are those big companies that overshoot to the upside when people are excited about the innovation and the investment boom, like you mentioned with railroads and others. So that's all fair game. I do wonder, in terms of the setup economically right now, in terms of what we can grasp. You mentioned that Bowman has kind of defined the hawkish edge of Fed rhetoric. It certainly continues to be the case. But we've also started to hear a lot more kind of commentary sensitive to the risks of the downside for the economy, and maybe the Fed's not going to be paying enough attention to those things. Is that something you're concerned about at this point?
I'm really not. Our big theme, Mike, this year has been that the Fed puts structures back. If we need them, they're there. We haven't needed them. We didn't need them last year. And I don't expect there's going to be enough new information before the election to really drive them to do anything significant. Maybe if inflation really were to come down super fast, we get some negative headline or core prints on the monthly numbers, or a big dip in the NFP and a rise to, say, 4.2, 4.3 quickly on the unemployment rate. You could maybe argue for something in September. But I think it's easier to just stand pat, watch the data, say we need more information, and then make some decisions once you know whether it's Trump versus Biden in early November. And they'll have 2 meetings this year to go on after they get that information. And the market will probably give them a lot of feedback to think about where financial conditions go after the election.